Hey everyone, I came across this question on the BTC website about one of the slides in the course, and this is something that I struggled with for a while to understand. So I thought I'd make a quick video of it, and thought it'd be valuable to share here as well to get some other opinions on it. And if you understand it differently or have any corrections to my logic on this, then please let me know. So the question on the BTC website is pretty much asking about the 40% to 60% rule and asking if this means an equidistant move. I think when Al mentions 40 to 60%, he is talking about an equidistant move. And so um, the question is, if the odds are 40% of making 1 to 1, then obviously it's not 40% of making 2 to 1. And I'd say that's accurate. A 40% chance of 1 to 1 means 60% chance of the opposite. So a swing trader should not be buying when there's only a 40% chance of 1 to 1. It's better to just fade that move, because if you're using a stop below the signal bar and there's only a 40% chance of going up 1 times before going down 1R, then you're better off just selling there instead and betting that the stop will get hit. So that's when it's a 40% chance of 1 to 1, it's usually not a good swing trade anyways. Usually the good swing trades are ones that are in a neutral environment. They're usually around 50% chance of 1 to 1. And then because it's a possible start of a move, of a larger move, it ends up making the math work for 40% of 2 to 1, 40% chance of 2 to 1. But usually a 40% chance of 1 to 1, the obvious trade, if you can identify that situation, is clearly a trade in the opposite direction, betting that the stop will get hit. And then the poster says that if we're saying that there's a 40% chance of 2 to 1, and we should go for 2 to 1 instead of 1 to 1, that wouldn't make sense to me either, because that would imply 55 to 60% chance of a 1 to 1 move. And both would be profitable strategies. So I created some slides here to show that it can be 40%. So there are situations where the edge of a 2 to 1 move for 40% might exist without a 1 to 1 edge. And so I'll talk about that here. So a neutral edge. So Al talks about all trades fall in the range of 40% to 60%. This can also be interpreted as the edge range is 10% above or below neutral. So 40 to 60% assumes always equidistant moves, 1 to 1, but all trades are not based on 1 to 1 strategies. So I think a good way to understand this is that it's always 10% above or below what the neutral range is. So for example here, for a 1 to 1 move, in a neutral environment, assuming that there's no edge at all, it's 50% chance of going up 1R before going down 1R, or going up 1 unit before going down 1 unit. And that would make the probability range 40% to 60%. So 10% below 50 and 10% above 50. But if a trader risks 2 times their reward, so you're risking 2 units to make 1 unit, then in a neutral environment, because your profit target is 2 times closer, or your stop loss is 2 times further than your exit target, now you're in a neutral environment, your probability of profit is 66%. So that's neutral. That's over 100 trades, over 1,000 trades. You're going to be right 66.6% of the time, but you'll be break even and probably negative with commissions. So in this kind of situation where you're risking 2 units to make 1, the probability range can be assumed to be 10% below 66.6 and 10% above 66.6. So in this kind of situation, the probability range that you should expect is 56.6 for a bad trade and 76.6 for a good trade. And there's always a possibility that can be beyond this range. So in strong breakouts with follow through and good contexts, Al often says that even for an equidistant move, it can often get up to 70% or 75% if the context is very good and the bars are very strong. So this is 40% to 60% is in most of the bars of the day when it's exhibiting trading range price action, which the poster mentioned in the question, that it's usually in broad channels and trading ranges. So most bars are in broad channels or trading ranges. So most fall into this category, but there are times when it can exceed that. And again, I interpret 40 to 60% as 10% above and below neutral, because in situations like this, you're not assuming 40 to 60% anymore. You're assuming 56.6 to 76.6. And then if you go 3 to 1 and 4 to 1, then obviously your probability increases, but the neutral probability also increases. So for 4 to 1, you by definition have an 80% chance of profit. But that's the neutral profit. So you don't have an edge. Even though you have 80% chance of making money, you don't have an edge yet. So in those situations, the edge would be from 70% to 90%. So 10% above and below. And then this is just the math showing that when you're risking 2 times your reward, your probability of profit will be 66.6%. So it's average profit times probability of profit minus average loss times probability of loss. And when you make them equal to 0, it shows you what the probability has to be for a break-even expected value. And that gives you the break-even probability. So here's an example of a situation where we have a big gap down and then a tight trading range to open and then a parabolic wedge. So breakout, pause, and then 2 more legs down. So we've met the expected criteria for the strong breakout down to 12, and we have a bull signal bar. So traders buying above the signal bar, it's greater than neutral. So it's not just 50-50 of 1-to-1 because the bear structure is complete. So there's a slightly better than neutral chance that we go up 1-to-1. And that's a guess. Like it could be 48%, it could be 55%, it could be 53%. So I'm putting something a little bit above neutral because that's what my interpretation is, but it could be within a range of 50%. And because of the context, because I already know what happens, and because this is a very common setup, which is one of Al's opening reversal setups with a parabolic wedge on the open, I think it's a little bit above neutral for 1-to-1. So 53% is fair, but 53% is not enough for a 1-to-1 edge in the long run. With slippage and with commissions, it's pretty much break even. So and maybe even negative because we can never be completely certain of this probability. It could be 51, it could be 49. So it's not worth taking because of the uncertainty, the gray fog, and because of commissions and slippage. It's probably not a great trade to take it for 1-to-1. But if a trader takes this trade, they're betting that this bar is the sign of buying pressure to initiate a new event. So that it might get up to the 14 high, the top of the wedge. It might get up to the moving average. It might reverse the entire day. We don't know, but a trader is betting that this is the start of something. And so let's say a trader takes this, betting that it's the start of something. There's a 53% chance of 1R, not a good trade on its own. So if a trader takes that, they're taking it for a swing. Now let's say it reaches that target. So now we reach this price. That's the 1R target from here. So we reach that price, and now we have 2 really big bull bars. So strong bull bars, gap with the 20 high, and the bear structure is complete. Probably going to test the moving average. At this point, there is a greater than neutral chance that we're going to go up 1 unit before going down 2 units. So here, the neutral for a 2-to-1, so risking 2 to make 1, is 66%. But this is not a neutral environment. This strong bull breakout is probably going to get a second leg up and probably going to get to the moving average after the end of bear structure. So we can look within this range and put it near 76%. And sometimes when the market's really strong, it can be more than that, but I'm assuming it's still within this range for a good trade for a 2-to-1. So 76% chance of reaching 1 unit up before going down to the initial stop. So if there was a 53% chance of reaching 1R, and then once it reaches 1R, there's now a 76% chance of reaching 1 more unit up before going down to the initial stop, then the probability of both of those happening, so for it to go up there and then go up there again, is the product of the probabilities. So 0.53 times 0.76, which is 0.4028, which is 40.3%. So it gives you a combined probability. If you're risking 1 unit to make 2, there's a 40.3% chance that it's going to get up there. And so that's how not having an edge for 1-to-1, not having a real meaningful edge for 1-to-1, can still produce a meaningful edge for 2-to-1, because how this forms up to 1-to-1 can determine a new probability for 1 more unit up. And if that probability is high and creates an edge, then you can get 40% chance of risking 1 to make 2. And so that's why Al often says that if you're taking this trade, you're hoping for a bull breakout. You're hoping for a strong event. And in those cases, when there's a strong event, now the probability is highly in your favor for a little bit more up. But because you bought here, you got a very good price. In other situations, Al says probability unknown or not great probability yet, better to wait for a bull breakout. So traders who don't want to take the swing, they can wait for the bull breakout, and they'll be in this scenario. So instead of buying down here and taking the swing, they'll wait to see if they get this. And if they get this, then they'll buy. And they might buy and buy more lower to change the math and make it better and more in their favor. But once you see the breakout, now the probabilities are better. The downside of this is that a trader who waits for the breakout misses out on this profit that a swing trader would make. But so they'll make less profit, they'll risk more, but they'll get better probability. The trader who buys down here for the 1 to 2, risking 1 to make 2, will get a better price and they'll get more reward, but they'll get lower probability. So that's kind of how they work together. If that makes sense, let me know. And if it doesn't, then also let me know, and I'll try to explain it in a different way.